All IPOs require company teams to market their offering to investors through a roadshow where they present the rationale for company valuation and the pricing of the offering. At FLG, we advise management teams and boards about the important do's and don'ts surrounding this important part of the IPO lifecycle. Here are some of those recommendations. Roadshow. First, know your buyers before the roadshow starts, because if you don't, your valuation is already dropping. Remember, bankers facilitate, management sells the stock. If you don't know who your likely buyers are for the investment, you may be fooling yourself about the likely outcome of your IPO. In choppy markets, it is even advantageous to have a book already spoken for at launch, sometimes referred to as a shadow book. And if demand turns out to be strong, you can always allow insiders to later scale back on their allocations. Also, be aware of investment bankers' dual loyalty. Investment banks are often working with funds several times a week. This needs to be a true long-term relationship. So be sure you understand where your company ranks within your own bank. For example, are they willing to go to the mat for you? Management needs to ensure they are building a long-term relationship with investors. Bankers will allocate just enough shares to investors to satisfy their demand, but not so much that they are tempted to sell over the near term. Those on the sell side will often relay their buy recommendations. Pay attention. Ideally, at the end of the day, you want to have the book multiple times oversubscribed. Valuation. Every CFO plays a critical role in justifying a company's valuation with investors, bankers, potential board members, and other outside and internal stakeholders. You need to mediate between the expectations of board members and current investors versus the banks and new investors. You need a fact-based, evidence-based logic trail, which you can articulate clearly with justifications for all of your assumptions about the market, your capabilities, the competition, and other relevant factors to your area of discovery. Valuations can be based on multiple methodologies, from benchmarking against publicly traded comp companies or IPOs, discounted cash flows, aggregating asset values, or sum of the parts. Do factor in M&A potential resulting from the deal, but don't just step up from the last private round. This can be misleading and frequently a fatal approach to valuation. Pricing. When pricing your offering, you need to be very careful. You need to decide on your strategy upfront. Do you want your landing price to be close to the offering price, thereby satisfying early investors but keeping a more stable playing field? Or do you want a big pop opening day, getting investors excited and engaging a much bigger pool? In our opinion, a well-executed roadshow, well-articulated, and well-thought-through valuation and strategically pricing your offer will lay the foundation for an IPO success.